Hi, I'm Patto from FreeFinCal, and in this video, let's review HDFC Balanced Advantage Fund. This fund has quite a colorful history, and many people have asked me after the SEBI mutual fund categorization changes, does it still make sense to continue investing in this fund or even consider this fund for fresh investments, that is, as a new investor? So this fund has, as I said, a colorful history. It has been managed from February 1994 by Prashant Jain, the same fund manager, which is a record for the Indian mutual fund industry. It was earlier called Centurion Prudence Fund, owned by the 20th century. I don't remember. Asset management, I've written it down in my post. Then it was acquired by Zurich AMC in 1998 and then by HDFC in 2001. So Prashant Jain has been the fund manager through these acquisitions. And if you look at the now since growth, that's it. That's a sight to behold. You don't see that often, right? Just imagine an investor's wealth if they had stayed put and kept investing more and more in this fund. So according to a Live Mint article, about 2,500 investors have continued to invest in this fund since 1994. And that is the normalized growth of this fund since 2001 May against Nifty 50 Total Returns Index. Please recognize that this is a balanced fund, or although it calls itself now a balanced advantage fund, it has always been a kind of aggressive hybrid fund, maintaining at least 65% equity since the rules came in, and that is a very good performance indeed. Now, after the SEBI categorization rules, HDFC announced in April 2018 that from May onwards, HDFC Prudence would be merged with HDFC Growth Fund, and it will be called as HDFC Balanced Fund. It's a very baffling decision why they would do that. They did that to both HDFC Prudent and HDFC Balanced as well. HDFC Balanced is now called HDFC Hybrid Equity. So for HDFC Prudence, the old asset allocation was 40 to 75% equity, although it remained an equity fund after the rules came in. The new asset allocation is it can go anywhere from 0 to 100% in equity. Of course, considering its high AUM, it will still remain a largely equity fund. Or even if it does not invest directly in stocks, it will have derivatives or arbitrage positions to ensure the 65% requirement is there, so that it's taxed as an equity fund. The old benchmark was CRISIL balanced with 65% equity in Nifty 50. The new index is the Nifty hybrid indices with 65% in Nifty 50. So it's essentially the benchmark has not changed. Only the benchmark agency has changed from CRISIL to NSE. So it's going to that is an indication that it's going to remain an equity-oriented fund, and it will be aggressive enough to be able to beat that. Beat 65% of Nifty 50. So let's see how it goes. But the only problem I have with this fund is that it is not very clear about what it would do. By calling itself a balanced advantage fund, it essentially belongs to the category of dynamic asset allocation funds. How would it dynamically asset allocate between equity and debt is something that's not clear. It says there are some vague statements like it will look at the market conditions and economic conditions and then change it, but that's just pretty vague. At least with respect to ICICI, we know that it follows a price to book model. Of course, that's one of the metrics, but this is very vague and I don't like that. So we are looking at the rolling returns of HDFC Prudence or HDFC Balanced Advantage with Nifty 50 Total Returns Index. We are looking at 3-year rolling returns. So in each of the blue and the red curves, there are 3,963 3-year return data points. And notice that for most of the time, the HDFC Prudence has produced a return greater than Nifty 50 Total Returns Index. That's pretty awesome. And I have a calculator for evaluating rolling rolling upside and downside captures. If you have seen my screener videos, I would have talked about upside performance consistency and downside production consistency. So I essentially calculate that from a graph like this. So what you see here, the blue line this is upside capture. Each data point is for a 3-year period. This is a rolling upside capture. Upside capture means that it tells you if how much of the benchmarks gains has the fund captured when you look at monthly returns. So higher the upside capture, the better. Notice that for between 2004 to 2006, the upside capture was significantly above 100%. So it was gaining more than the benchmark whenever the benchmark gained. Downside capture is the opposite. Whenever the benchmark falls, we find out how much the benchmark, how much the index falls. So that should be less than 100%. But this fund does not have a very good downside protection history. It typically has hovered around 100% or a little more above that. But only recently it has the downside protection has increased, and of course the upside capture has also decreased also. But that's fine. When I say downside protection has increased, the downside capture has fallen down. So you notice that. Let me not confuse you. So around this region, notice the downside capture is 70 to 80%. So it means that it only captures 70 to 80% of the index falls. So that's pretty good. So that's fine. If you don't understand this graph, don't worry about it. Just read the text. I might have done a better job of explaining. So these are 5-year rolling returns of the fund with Nifty 50. And that's again awesome. There's like 3,200 data points, and again over 5 years, it has benefited investors who have stayed with it for 5 years at least by beating the Nifty 50. Of course, the returns can be anything. Notice that even in the recent times, the outperformance is still there, so it's not bad at all. Now, this is the product positioning of HDFC mutual funds, the hybrid funds. So this is a graph of risk versus reward. The risk is expected risk, means guaranteed risk pretty much, and this is a potential return. That's what I would like to call it. So notice that HDFC Balanced is higher than HDFC Hybrid in the positioning ladder, which means that it will be more risky than HDFC Hybrid. And that's strange, because the aggressive hybrid fund is expected, at least the way SEBI has designed it, or at least from the way ICICI Balanced Advantage operates, we have come to expect an aggressive hybrid fund to be more volatile than a balanced advantage fund. But this is ulta in the case of HDFC Mutual Fund, and it's expected considering the history of HDFC Prudence, but it may be difficult for investors to come to terms with it. But old investors may feel okay with it because they're used to it. But new investors should understand this before they jump into it. They should not think balanced advantage is less volatile than HDFC hybrid. Now, I have now compared the rolling returns over 5 years of HDFC hybrid equity, which is the old HDFC Balance, which is the pink line, versus the HDFC Balanced Advantage, which is the blue line. I have also added Nifty 100, Nifty 200 and Nifty 50, the red line, green line and white lines. So it will take some, you have to look through because the lines are falling one on top of each other. Notice that in the past, the blue line was above the pink line. So HDFC Prudence was outperforming HDFC Balance, but recently, over the last few years, HDFC Hybrid or HDFC Balanced has been outperforming HDFC Prudence, and this outperformance has come at lower risk. This is the rolling risk or the rolling volatility graphs over 5 years, and HDFC Hybrid Equity or HDFC Balanced has a lower volatility than HDFC Balanced Advantage. So HDFC Hybrid is able to outperform HDFC Balanced at lower risk, which is awesome. But if you look at HDFC Balanced on an absolute level, it has got significantly lower risk than Nifty 100, Nifty 200 and Nifty 50. So there's no problem. But of course, you can also argue, and I would argue, that the difference in volatility between HDFC Balanced Advantage and HDFC Hybrid is not so much. It's not too big, so it's not a big deal. But for new investors, it makes sense to choose HDFC Hybrid than HDFC Balanced Advantage. So HDFC Balanced Advantage remains a fantastic choice for existing investors. They are used to its volatility. I don't think they should expect its volatility to come down. Although it's too early to comment about what kind of balanced advantage strategy it will follow. We don't know that yet. It's only been about a few months, so we'll have to wait and watch. But I am an investor in HDFC Balanced Advantage as well as HDFC Hybrid, and I'm going to hold on to both. And new investors can consider HDFC Hybrid Equity or ICICI Equity and Debt Fund instead of HDFC Balanced Advantage, because these funds offer better returns at lower risk, which is awesome compared to HDFC Balanced Advantage. ICICI Balanced Advantage is also a very good opportunity, of course, very good fund to invest in, especially by new investors who are scared of the markets. This fund will give you more or less decent returns at very low risk. The ICICI Balanced Advantage has got much lower risk than the other funds, but its returns may not be as high. So it can be a very good first fund for a new investor who's kind of scared and so on. It can also be used for post-retirement corpus, of course, if managed properly. So that's all I have to say about HDFC Balanced Advantage. If you have any questions, let me know. Many people have asked me about SBI Blue Chip, Motilal Oswal funds, L&T funds, and so on. Let me do that one at a time. My goal in reviewing mutual funds, let me be frank, is that I look at the AUM. If the AUM is large, then the potential viewership from YouTube search engines, Google search engines will be high. That is the reason for me choosing these funds. So I'll get to the other funds. I have them in my list. I will get to it one by one. So thank you for watching. I'll catch you again in another video. Bye bye.